Welcome to Mature Moneymaker. Today, we're exploring investing for beginners. If you're new to investing or curious about where to start, this video will give you a step-by-step guide to stocks, bonds, ETFs, mutual funds, and cryptocurrencies. By the end, you'll have a solid foundation to make smarter, more informed investment decisions. Let's dive in. Let's start with the basics. What is investing? Investing is when you use your money to buy assets that have the potential to increase in value over time. Think of it like planting seeds in a garden. You nurture them, let them grow, and after some time, you enjoy the fruits of your labor. Whether you want to build a retirement fund, buy a house, or even achieve financial independence, investing is the tool to get you there. The big goal? Make your money work for you. You might be wondering, why should I start investing? The biggest reason is inflation. Over time, inflation decreases the value of cash, meaning things cost more every year. If your money just sits in a bank, it loses purchasing power. Investing is a way to not only protect your money from inflation, but also help it grow. With a smart investing plan, you can multiply your savings and build wealth over the long term. 1. Different types of investments. Stocks. First up, let's talk about stocks. When you buy a stock, you're purchasing a small ownership stake in a company, also known as a share. If the company grows and becomes profitable, the stock's value generally goes up, and so does your investment. For example, if you bought a share of Apple a decade ago, its value would have increased significantly by now. Stocks have higher potential returns than most other investments, but come with higher risk too, because a company's stock price can fluctuate based on factors like company performance, industry changes, or even world events. This makes stocks ideal for people comfortable with risk who aim for long-term growth. 2. Bonds. Next, we have bonds. Bonds are essentially loans you give to a government or a company, and in return, they agree to pay you back with interest. Bonds are generally considered safer than stocks, which is why they offer lower returns. There are different types of bonds, like government bonds, which are quite safe, and corporate bonds, which can be riskier. For example, a government bond might offer a 2% return per year, which is steady but low. People invest in bonds to add stability to their portfolios, especially if they want predictable income with less risk. 3. ETFs, exchange-traded funds. Now, let's discuss ETFs, or exchange-traded funds. An ETF is like a basket that holds a variety of investments, such as stocks or bonds. When you invest in an ETF, you're buying a small slice of everything in that basket. For example, a technology ETF might include stocks of tech companies like Microsoft, Google, and Facebook. The advantage? You get instant diversification, meaning your risk is spread across multiple investments rather than just one. ETFs are popular with beginners because they're relatively low cost, can be traded like a regular stock, and offer exposure to entire sectors or markets. 4. Mutual funds. Then there are mutual funds. Like ETFs, mutual funds pool money from many investors to invest in a diversified mix of assets. But here's the difference. Mutual funds are actively managed, meaning a fund manager picks and chooses where to invest on behalf of all investors in the fund. This professional management can be helpful, but mutual funds often come with higher fees than ETFs. For example, a mutual fund focused on large-cap stocks might include blue-chip companies, but you'll pay a fee for the manager's expertise. Mutual funds are great if you prefer a hands-off approach and don't mind paying for the guidance of experienced fund managers. 5. Cryptocurrencies. Finally, we have cryptocurrencies. Cryptocurrencies like Bitcoin, Ethereum, and others are digital or virtual currencies that don't rely on governments or banks. Instead, They use blockchain technology to secure transactions. Cryptos are known for their high volatility, meaning they can go up or down dramatically over a short period. For example, Bitcoin's price might double in a few months, but it could also lose a lot of value quickly. While some people have made big profits with crypto, others have faced huge losses. For beginners, it's wise to approach crypto with caution and invest only what you're willing to lose. Key investment tips for beginners. Before you start, here are 3 tips to help you succeed as a beginner investor. 1. Start small and build confidence. You don't need a lot of money to start investing. Even investing a little each month helps you build the habit. For example, if you can set aside just $50 a month, that's a solid start. Many platforms let you start with small amounts, so you can learn and gain confidence. 2. Diversify to manage risk. Remember the saying, don't put all your eggs in one basket. Diversification is key. By spreading your money across different investments like stocks, bonds, and ETFs, you reduce the risk of losing money if one investment doesn't perform well. 3. Be patient and think long-term. Investing is a marathon, not a sprint. The stock market, for example, has its ups and downs, but over the long term, it tends to go up. Avoid getting caught up in daily changes. Remember, you're investing for future growth. Thank you for watching Mature Moneymaker. I hope this breakdown on investing for beginners has given you some clarity. Investing doesn't have to be complicated. It's about finding what suits you and building wealth over time. If you found this video helpful, please hit that like button and subscribe to stay updated with more tips on finance and investing. Have questions or a topic you'd like us to cover? Drop it in the comments below. Until next time, keep growing your knowledge and taking steps towards financial freedom.